This video demonstration takes us through the analysis or the way of analysing one of the most popular property investment strategies that has come in over the last half century or so. And this is known as negative gearing or sometimes negative leveraging. It turns out to be a fairly easy thing to analyse, and that's quite important because although a lot of people have made a lot of money with negative gearing strategies over the last half century or so, it turns out that there are some very good reasons for being suspicious of negative gearing being able to deliver the same kind of performance into the future. And so what we need to do is develop a way of analysing this rather complex strategy. And we're going to do that by simply adding it into our basic DCF model as a way of looking at a negative gearing strategy using the model that we've built. What we need to do is simply add the parameters for our investment into our existing DCF model. You'll notice that here we're looking at an analysis period over 10 years, and we're also looking at a very ambitious market growth rate. We're using 10% in this case. You'll notice that most of the models that we've been doing use relatively modest growth rates compared to this. However, the 10% growth rate is fairly representative of what growth has been at various periods in history, certainly over the period 1972, somewhere in the mid-2000s, probably 2005, 2006 perhaps, certainly up around there. You'll also notice that it has a very low gross yield. And so all we have to do is put that into our model. Now the next part we have to do is build an analysis table for our tax. And we have to put that into our DCF model as an extra. And so we're going to add that into our model. We've got the notes, if you like, on how that works. And we've got the table here on our PowerPoint. But now what we'll do is go into our model and look at actually how to put that in. You'll notice that we have this tax table down the bottom of our model here that has simply been added into a convenient location, in this case in columns L to N and down around the bottom of the table. So that's fairly straightforward. What we're going to do now is go through the various elements in the table. The first thing is the tax on operations. And so we can look at that and see where it comes from. We see it's simply a summation of basically two rows. And that's the row for the basic tax, tax on cash flow, and also the depreciation. The next item is the capital gains tax. That very simply is taken from the capital gains tax calculations as minus S8. Notice the negative value in order to correct the signs. We simply sum both of those to get the total tax. That can be done either using the sum function or a simple plus. Both will give you that total. And that gives us the total tax that's paid. Next we need to look at the total net revenue. And to do that we start off by looking at the total taxable cash flow. Again, to do that we use the sum function to take a sum of the row that is above the income tax calculation. Next is capital gain. Now that's still a part of income tax. Capital gain is quite simple. It simply brings down the value in S7 from our capital gains tax panel. So that also is very straightforward. The capital expenditure is a capital expenditure item that needs to be included because it's not part of your operations and it contributes to the capital gain effect, but it's not caught in the capital gains tax calculation. And so it is simply brought down from the capital expenditure cell. And by the time we sum those, we end up with the net taxable earnings. And we do that, again, simply using the sum function, where you can use it as a couple of simple additions. Once we have those two numbers, we simply divide the total tax by the taxable earnings, and that gives us a 13.78% for this particular example. This panel is quite powerful because once we have the panel worked out, this will then respond to any model we put in, which is particularly useful for negative leveraging. And I'll leave it to you now to put in a sensitivity table, a what-if table, looking at the effect on effective tax rate, currently at 13.78, as you change your property growth rate. Here we show the table from the what-if table and also a graph which has been produced. As we look at this, you'll notice that the table has some rows where there's no internal rate of return, and that's because at very low growth rates the investment performs so badly that Excel won't produce an IRR, and you can see that when you look at the NPVs becoming quite seriously negative. The advantage of the table is that it calculates the effective tax rate as well here, and you can see that it goes from relatively high, around 26, 33, 41%, depending on that ratio between total income and total tax. But then in the middle, it runs up to astronomical height where you're actually making very little income, but paying a fair bit of tax. But then as the growth rate gets higher, progressively the profitability becomes quite high. And this should make the attractions of negative gearing in a high property growth environment very, very obvious. When we move down and look at the graph, we see a similar pattern, only pictorially. We've also put in graphs of IRR and NPV against property growth rates, and there it's quite obvious that the effect of property growth is quite spectacular with a negatively geared property. In particular, you can see NPV basically going through the roof when property growths get up to the kind of numbers that people were expecting, say around the early 2000s. The bad news is the bottom part of the graph, where low property growth comes in as spectacular failures. And so you've got an NPV in the vicinity of minus $100,000 for a property worth only $300,000 or thereabouts. Likewise, the NPV goes through the floor. However, Excel's not able to calculate it. And overall, what this points out, what it illustrates, is the extreme sensitivity of negative leveraged property investment to property growth. And the problem is that property growth is totally in the future. It depends on just how well the economy and the community's ability to pay rent and so on is. And so if you come into a negative geared strategy at a time in the market where property growth is going to be strong, it can be spectacularly effective, like any other form of leveraged investment. However, if the outlook for the property market is more sober, then negative gearing becomes extremely risky and extremely costly. It's almost parallel to trading in the futures markets and other derivatives, where you have the opportunity for a major upside, but also spectacular losses. Now, the negative gearing strategy took root in the 1970s, became well developed in the 80s and 90s, was sold through the early 2000s. But basically from about 2005 onwards, it has become extremely risky, especially in markets that are faltering. For people considering property investment today, in most markets, it should be obvious that analysing negative gear strategies with something like the DCF capability that we've been working on in this course is extremely important. We only find a couple of markets in Australia currently looking in any way bright, and even those are not seen to be necessarily a good bet in the longer term. Overall, this means that what has worked for something like an entire generation seems to be coming to the end of its usefulness, if not becoming a major financial hazard.